Good morning, everybody. My name is Don Daniel, founder of P.I.L.L Method International, a better way to eliminate debt. And today we're going to be talking about why nobody's borrowing money. I mean, the money is there. The builders have the houses. Before there was a shortage of houses. Now they have 8 to 9 months inventory. And no one is borrowing the money. And I have a special guest with us this morning. His name is Jerome Pemberton. Jerome, good morning to you, sir.
Good morning, Don. I'm excited to talk to people this morning. I want to know from your fan base, your viewers, why aren't they purchasing right now when the amazing strategy that you have and showing people how they can pay their house off in a short period of time? I want to know who's scaring them. That's what I want to know.
I want
to know why are so many people scared? And home ownership, in my opinion, over the last 25 years I've been in this business, I don't know why people are scared of a 7% rate. As long, like you say, as long as they can make the payment, right?
Right.
The banks are giving money. This is nothing new, where a person doesn't have to put a down payment down. And Don, what I'm finding out, there's a lot of people that have money in reserves. They're still not making a move because of fear. What things are being said in the news. There are also a lot of people purchasing home right now, and people don't realize it because they have understanding, Don. They have understanding. They understand that a 7% rate is not a high rate. They understand that if you look through history and you have your data, and you're making more income and you can make the payment. And a lot of people don't like talking about, a lot of the bankers don't like talking about this, but if you look at a VA loan, a veteran loan, they're not putting a down payment down.
Right.
So everybody has the opportunity to do it if they're working with the right team and people that's knowledgeable and been in the industry long enough.
Well, speaking of team, we have some people here that I'm adding to the stage right here. Some folks that you probably know. We have Alex on the team. We have Mario that's with us this morning. And listen, I need to hear from each one of you because see, I talk about it once we're getting the loan, after we get the loan, but you guys are on the forefront. You guys are helping people get these mortgages. And for some reason, they're sitting on the sideline. What have you guys found out? What are you hearing that people are not willing to borrow this money? I mean, the banks are just chomping at the bit. Talk to me.
So let me introduce everybody. We've been together a long time. Mario, Alex. I started out when Alex found me. I was on just strictly mortgages, and what I found out that a lot of agents didn't know. We're very well versed on the financing side and the real estate side. That makes us very, very, I believe, unique, and we understand how money works now. And so Mario is the broker of the whole team for our brokerage, and Alex is he's a partner. We're all friends. And my specialty is I'm program director, and all I do is look at programs, Don. And I'm gonna let Alex and Mario introduce themselves, and they can literally talk to you about the amount of transactions that's being done that does a year. Like, we're on the boots, we're on the ground, we talk to a lot of people. Laura is just coming in. She is the actual bank that I use for my kids and for myself, and she'll talk about a product. And she has they have a special relationship with us that Around Town Property gets credits to use for our buyers. And so we're all excited about you giving the illustrations of how somebody should apply their down payments and how much money they're going to be able to save by doing it the right. In my opinion, the right way.
Yes,
is that the down payment should be applied after you purchase the house.
So my goodness. Hold on, I have one person. I have one person in my audience that I have Nikki here. Nikki, how are you doing this morning?
Yeah.
You doing okay? All right, we can't hear you for some reason. You may want to go out and come back in if you want to have if you have questions or comments. But Jerome, go ahead and introduce the rest of your team.
Well, Mario, introduce yourself, then Alex, and then Laura.
Good morning. My name is Mario Negron. I'm the broker with Around Town Properties. I've been doing this since 2007. We help match people with their perfect home. It's a fun story how this all happened. I was in the building business and decided to go to the real estate side, the front side. Used to work in a lumber supply yard, so we help the builders. And it's more gratifying to help you find your home. There's a lot of free money out there. You'll be surprised where money's hiding for you to help you buy your home, and we're here to help. Alex?
Excellent.
My name is Alex Resende with Around Town Properties, known also as the New Home Dude. So I started selling new homes back in 2003, December 2003. Been selling homes ever since. And one of the things that I can tell you is that a lot of people just don't understand how process works. And they've been turned down in so many different ways. And they're just scared, right? Because it's a big purchase. So most of the time, just walking people through the process and explaining how it works and breaking it down allows them to realize that it can actually be done. And maybe they're not ready right there and then. And I'm sure Laura can talk about that a little more. But with a really good game plan and a team behind us, and we can set them up to be ready pretty soon. So that's usually how we go about it. Is just explaining to people that it's not a matter of if, it's a matter of when,
Okay, Miss Laura.
Exactly, Alex. I never say no. Sometimes it's not right now, but it's never no.
Yeah.
My name's Laura Doremus. I am a mortgage loan officer with TDECU. We are an equal housing lender, and my NMLS ID is 602776. Have to get that out of the way. But I've been doing mortgages for almost 30 years. I know I started when I was 3, but
I believe it.
But that's always been my approach, and I think that's one of the reasons Jerome and I have just worked so well together. We really truly care about helping people get into homes, and we know that this is one of the biggest ways you can build wealth. So we have some awesome loan products here at TDECU that not a lot of other lenders offer, including our no down payment, no PMI, no origination loan. So I'm sure Jerome will probably mention a little bit about that. He's one of our biggest fans, so I appreciate that. But we do all of the traditional loans, but that one's a favorite for a lot of reasons, and I'm just here to support and answer any questions and help any way I can.
Well, thank you very much for that. So, Jerome, listen, man, you called me this week and you were talking about that builders are out there looking for people to buy their product. Lenders are out there looking for people to buy their mortgages. Why aren't people borrowing? What's going on?
I can only explain the calls that I've been getting.
Let's talk about
that. A lot of noise out there on the internet. You got some people out there, they're doing and giving information only to get views on the internet, on YouTube, Instagram, it could be Facebook. So what they're doing, I'm in classes now to get views. It's all about what can I see was trending. Let me talk about it to get views, to go viral so more people can look at a channel. So now you have a lot of people out there, whoever has the largest platform and that's talking, doesn't mean they're in the business. Notice what I said, no matter, it's who they're going to listen to because they listen to that person or that platform the longest. I'm only going by what I hear from people. But when we break the numbers down in the simplicity of how a person can purchase a home, and we break it down, it's either your income, it's your credit, your savings.
Okay. Well, talk to us. What are you hearing most?
I'm hearing most of right now is that people still want to be a home, but they may not know the credit score they need for a specific program. So for a lot of programs,
let's get straight to it. So let's say you got a person who is interested. Their credit score is okay, but they're still not wanting to borrow. Why don't they want to borrow? What are they telling you?
A lot of people will borrow if they have clear understanding and they trust what what I'm saying or what Mario's saying, what Laura's saying, what Alex is saying. They might have talked to 3 or 4 other people first. Then it's a battle of if they trust what we're saying. And what we're saying is a little bit different. We're saying we know the programs. We know we can put you on a clear path. Most people, most of the calls that I get, they don't have clarity in their they're clear about their decision,
Right.
but they're not clear about the path they need to take. So they're just out there listening to a bunch of people and trying to decide what they feel is the best for their family. What we're going to go over today, when you show, if we take out the equation as no down payment,
Right.
and you can afford the payment, then what is left? Especially a lot of people have money in their 401k. They have some money in the savings. No matter what, they're making a payment is either in rent, or they're making it in rent, or they're making some type of payment somewhere, paying the family or things like that. They're making some type of payment. Alex, you want to chime in it? Because
let me add some. I think what Don's talking about and what we hear, I think is rate, right? A lot of times is interest rate. That's one of the things that people get. And I think is the funniest thing. I look at interest rate as a girlfriend, right? You're going to be laugh at me why I said that.
Right.
But think about it this way. Nobody wants to introduce anybody an ugly girlfriend, right?
Yep, that's
when
right.
people buy a house, they don't want to tell somebody that they're paying 7% interest rate. It looks like an ugly girlfriend. They want to tell everybody that they're paying 3.5, 2.99, 4.5, right?
But those aren't coming back.
And that's what happens, right? But we always tell them the same thing is don't marry the rate, marry the house, right? And then the rate can be refinanced later. But the first thing people ask usually when they buy a house, sometimes they don't ask how much you paid because they don't want to kind of intrude in the business too much.
Right.
You ask about rates because they're also questioning to whether it's good for them, right?
Right.
So when the rates are higher, people freak out a little bit. They kind of look at it and they're like, well, I don't want to pay that. But how much are you paying on your credit card? How much are you paying on your cars? How much are you paying on other things that you finance? The house is still the lowest interest rate you can pay on anything you purchase, basically, right?
Okay.
So, but a lot of people don't understand that, and then they get freaked out over the fact that the rate sounds high than it used to be. But you and I both know that it's still the lowest it's been in history, right?
Well, let me tell you what we're going to be talking about today. One of the things that we're going to be able to share is what are you seeing as interest rates right now? About 6.5 to 7. What are you seeing?
It depends, right, Laura? It depends on different scenarios.
Okay.
You could talk a little bit more about that.
Well, I've seen it lower, definitely. I mean, there's several factors that determine a rate: down payment, loan amount, loan to value ratio, obviously, like down payment, but credit scores as well. So all of those things are factors in determining interest rate. But just to give you a range, I locked someone below 6 just the other day, depending on the program, like I said, we have that no down payment, no PMI, no origination fee. That's a little higher. It's in the 7 to 7.5% range, but that's, I guess the trade-off there, they're for buyers who may be limited on cash for closing or not wanting to touch their investments. It's a great way to get into a home with very little, if any, money out of pocket.
I love that. Folks, what we're going to be talking about is how can we use these incentives to maximize interest savings overall? Would you be surprised to know that I actually love a 7% rate, and my clients can actually save more interest at 7 than they can at 5.5 if they know how to read an amortization schedule?
I agree and believe with that. Yes, that's correct.
Yeah. So Don, we ready. So let's get right into it. Let's show the illustration of the 7%. And I have a real live illustration if you could do it for us. I have a client for a builder, $600,000.
$600,000. Let me put that on the screen. I add it to the screen right now. All right. So we're going to do 600,000. Got it?
Don, so I want to show an illustration. The builder friend called me, and this client wants to put $200,000 down.
And the interest rate is?
Let's just use 7%. Let's just use it as an example.
All right, we'll just use 7%. All right, and they want to put $200,000 down. So we're going to duplicate this, and then we're going to show the difference. Okay. All right, so we've got. Let's see here, 600,000. Okay, so we're going to duplicate that at 7, and then we're going to do, and if they put $200,000 down, then they want to, then they're going to do 500,000 for 30 years at 7%. Okay, so I got the two loans. I got 600,000. And you said they want to put 100,000 or 200,000 down.
$200,000 down.
Okay, then okay. All right, we've got 600,000. Then we need 400,000 here. Okay, and change the payment. There we go. All right, I got your scenario. Tell me what else is happening here.
So Laura has a program where they can do 100% financing.
Okay,
they don't have to put the $200,000 down.
Mm-hmm.
The illustration, if you could show if they put the $200,000 down and what's going to happen after they close. So they close with Laura at the credit union.
Okay,
at a full $600,000.
Right.
What's going to happen to the amortization table when they put the $200,000 after?
I got it. So let's set this thing up right for everybody. We've got, if we're comparing, when we compare two 30-year loans. So when we look at the numbers, all right, here is the summary on that. On the $600,000 at 7%, total interest paid on that is going to be $510,000. Okay, the payment is 25, 28, 27 for principal and interest. If they put, let me see here, what's going on? 600,000. Let me do this. Okay, we got 600,000 and we got 400,000 at 7. All right, that's the two loans. All right, so we're going to do the comparison again. We got payment is $39.9181. Total interest paid on this is $837,000. That's what people look at. But if we put $200,000 down, look at that payment. It's now $2,661. Total interest paid over 30 years is $558. Now, if I'm looking at just the summary, I might go with the $200,000 down. I mean, who wouldn't? Okay. But let's take a look at how to read an amortization schedule. First, let's go back to the 600,000 and let's just show, let me get rid of this advertising here. Let's understand what's really going on. When we break down that payment, on that very first payment, $491.81 goes to principal, $3,500 goes to interest. So this is how we need to read an amortization schedule. Let's just say we make a first payment in January. If we do, we're all done for January. If we look at February's principal payment, it's $494.68. For all of our experts on the panel, is if I make my payment in January, do I have to wait till February to give the bank an extra $494.68?
No.
No, if I had it, I could give it to them in January as well, couldn't I? And if I did, all of this money would go straight to principal, all right, because I've already paid my mortgage I already paid my mortgage for January. So if I give them this $494.68, they have to subtract that from my principal. I'm paid down to line 2 on my amortization schedule, which means my next mortgage payment for February is now on line 3 of my schedule. If that's the case, what happened to this $3,497.13 in interest that was supposed to be paid on line 2? What happens to that?
Oh.
It's gone. We just saved almost $3,500 in interest just by prepaying $494.68. I mean, the amount of money that could be sitting in a bank account only making 0.1%. We could take that or apply this to this mortgage. This is how interest cancellation works, folks. Most people don't understand that if I prepay, how much interest am I actually saving? So now let's take a look at these two loans this way. Now, this person says, I want a $400,000 loan. I want a $400,000 loan. So I can save interest, I can save time. Well, look what happens if they start here. Okay? If they start here at the $600,000, where if they didn't put anything down, they still have their $200,000, don't they, Jerome?
They still have that $200,000.
Okay. Then if they were just so excited about putting that $200,000 as a down payment, can they use it now as a prepayment?
Yes.
Yes.
All right. Well, if they did, this column adds up all of the principal payments here. This is column 3, cumulative principal. Let's just scroll down to 200,000. Well, if I go down to just 27,000, that knocks off 4 years off this loan, doesn't it?
Yep.
Look at my interest savings so far, just at 27,000 prepaid. Let's go down to 100,000. Okay. Now we're at between 99 here and 100,000. Okay. We've just knocked off 135 payments in 1 month, haven't we? Just with 100,000 down.
Mm-hmm.
Look at our interest savings here. We go all the way down to 200,000 prepaid. There it is, 217,000 prepaid. Okay. Do we still have a $400,000 loan over here, ladies and gentlemen?
Mhm.
Okay. But we are 209 payments into a 30-year loan. We put a calculator on the screen. 209 payments, 209 divided by 12 with a $200 prepayment, $200,000 prepayment instead of a $200,000 down payment. We just knocked off over 17 years off a 30-year mortgage. Ladies and gentlemen, who are the experts in the room, do you see anything wrong with this scenario if we were going to use the $200,000?
Yeah, more people don't do it. Yeah.
Does this make sense to everybody here?
Oh yeah.
Okay. So now there is a better way to even use the $200,000, but this is just some mortgage mechanics that we have not been taught as the general public how mortgages actually work. And because of that, we follow the advice of experts. If you have it, put it as a down payment. And here is what here's what they're showing. If you use it as a down payment, okay, instead of a prepayment, then instead of paying $837,000 over 30 years, you'll pay $558,000, and they'll subtract those two numbers and say, well, that is your savings. Okay, we'll just call it $300,000. But if I put this down as a prepayment on the loan for $200,000, now we're looking at $631,927.78 interest savings in just 1 month. Folks, if we make our payments every single month on time for 208 months, 17 years, you will pay this loan down by $198,000, and it will cost you $631,000 in interest. But here is something that's exciting. What we need to look at is, where are we as far as how much we owe? We owe this. How can I figure out how to use my money so I can owe the same amount, but I don't have to give the bank $631,000. If I were to give that payment $200,000 on line 1, guess how much interest I would pay? Here it is, $3,500. To get to the same place on the amortization schedule. I just get excited about that.
Yes, that's amazing.
Yeah.
Any questions? Any comments?
Well,
I
I
was
mean,
explaining to Laura. Go ahead, Alex.
yeah. No, I was going to say the thing about it is, you know, Jerome and I talk about this all the time when we talk about also the fact that, you know, when you're talking about the majority of the people doing the down payment assistance program are usually beginners, right? They're usually first time home buyers. We try to explain it to people that are not, which this will be even more beneficial to them because they actually have 200, 300, whatever for down payment, where a person starting out doesn't.
Yes.
But when we talk about it, the other thing that comes into play with the amortization table as well is that the average person only going to live in the house between 4 to 7 years. So they're paying interest for those 4 to 7 years, barely making any principal interest, basically, right? Any payment on that. And they're still making it complicated by thinking about, oh, the rate is this or that is that. If they rent it for 5 years and they buy for 5 years, they're still always going to be ahead with the purchase.
Exactly.
But the commitment is what freaks them out. And when you look at it, well, the commitment with the renter is worse. If you're behind on your rent, you can get evicted in 7 days. If you're behind on the bank, it takes them months, right? So there's a huge difference on that. So
huge difference. And not only that, but when you're taking a look at this, what you're actually buying here, folks, is equity.
Yeah.
Okay. Every single month you make a mortgage payment the way the bank says to do it, you're gaining equity over here. These are your equity payments. This is potential equity, $500 a month. But each month it costs you $3,500 to get it, $34.97 to get it, $34.94 to get for about $500 worth of equity. You tell me, is it worth it?
no.
Is there a better way to give them $400? So think of it this way. If you pay on time, this is what it costs. Anytime you give the bank any amount of money when they're not expecting it, you make it impossible for them to charge you interest on that money. How about that? Okay. So I can make a payment here. I can make a prepayment of $6,000. I can make a prepayment of $6. But if I knew that for every dollar I put on, well, let's just do the math. Let's just do 1 month. Okay. I'm going to prepay $494.68 here. Okay. And I'm going to save $34.97.13 in interest if I do this on line one. So if I save us $34.97.13 divided by what I'm prepaying, $494.68 divided by 494.68 equals $7.07. Every dollar you prepay at this juncture is worth $7.07 worth of interest I don't have to pay. Now, if I put $1 on a $600,000 mortgage, I don't get excited about that because I'm looking over here. But if I knew how much interest I was actually saving for every dollar, wouldn't that be more exciting?
Yep.
Oh my gosh, that's a 700% return on your money. How many people? Go ahead, Jerome.
So, Don, so when we're talking to people, especially the first-time home buyer,
yes,
I guess I'm asking the panel, I guess we have to talk to them about, in this scenario, I don't know what it would look like on a $350,000 house, but basically, if there's a way for a family to put find an extra $500, would drastically change their situation per month.
Yeah.
And Alex, later on, when you sell the house on the listing, I wonder how much damage that would do after, let's say, 5 years.
5 years. Okay. So you're saying 5 years of prepayment?
$500 a month for 12 months or 5 years. Is that what you're saying?
They were just doing that because most families that I talk to, if they saw this platform, they got to make a decision if they want to use that platform, because we kind of sell it, you know, there's a lot of emotions in the transaction. They probably never get a chance to see this model. That's why we're doing this today, so we can give it to our clients so they can see the power of playing the amortization game and building more equity, right? Because we always talk about the equity. What I'm saying is, if there's a way, even if they had to Uber, work an extra job for extra, I don't know what people do to get an extra $500 a month if they focus on the $500 extra.
Jerome, is easier than that. Can I show you how you can get that money? It's easier than that.
Sure.
Go ahead.
Here's what's happening, and you guys know this more than I do. When you're taking an application and you ask people, how much are you making? How many of your clients have to look it up?
A lot of them.
People don't know how much they're making. When you ask them, well, how much are you spending each month? How many actually have to stop and look it up?
Not as many.
Okay. So here's what we're looking at, folks. If people were to track how much their expenses actually are, okay, just write it down in a notebook. I'm spending this much on food. I'm spending this much on gasoline, on insurance. So this is what it costs me to pay my bills each month. This is how much I'm making. Do you realize that I had a person do this? Because part of what we ask our clients to do for us is tell us a key number. What is your discretionary income? How much money do you have left over after paying all the bills? I had a lady tell me, she asked me, what if I don't have any money left over? I said, well, that's kind of hard. Well, let me ask you this. Do you ever have to use a credit card to pay your bills? She said, no. I said, do you ever have to go into your savings account to make up a shortfall just to pay your bills? She said, no. I said, well, then you have money left over. I had her do a budget form. It took her a couple of days to get that budget form back to me. I said, why did it take you so long? She said, I had to do it 3 times. I said, why'd you have to do it 3 times? She says, after I got through doing the math, it was showing that I had $2,000 left over after paying my bills, and I don't know where it's going. So what if people just track that, Jerome? Track how much they're making and how much they're spending and see what's actually left over. They can put the leftover in the bank, couldn't they? They don't even need to Uber. We just need to manage what we have. That's what we do for most of our clients. So what if they did that and had that extra $500 that you were talking about? And that would be a lot easier, wouldn't it?
That's easier.
Yeah.
Mario, how does this help the conversation we had yesterday with our Latino families, and they want to pay their houses off faster? Would this help any? If they show this illustration?
This is so one thing that we need to step back and look at the Latino culture for everybody. They believe in generational wealth through real estate. 95% of the people in Mexico own their homes outright. You'll be surprised if they find a piece of land and they build slowly until they have their homes. A mortgage over there, average interest rate is 19%.
Oh, wow.
In Mexico, guys, we're the only ones in the single digits. Start looking worldwide at interest rates. Everybody's in the 13s up to the 20s, up to 25% interest rate. So they believe in finding their home and paying it off quicker. You'll be surprised how many of my clients that are first-time home buyers have worked until they're 45 years old to put $150,000 down payment, thinking that that's the equity they're going to cash out in the future. Don, with your method, we can turn around and show this to them, and they're going to turn around and save more money because they qualify for the house. They've just been sitting on the cash and hoarding the cash for all these years. I'm currently helping a lady. She's sitting on $250,000 down, and she still hasn't made a decision because she's scared because the interest rate's 7%.
Well, let me show you something here. Let me show you something that's going to really, really excite you. I just put in 200,000 pesos, or it'll probably be like $1.5 million pesos, but I just put in $200,000 at 19% interest. Okay. The payment is $31.77 78. But look at how the amortizations shakes out. $11.11 going to principal. This much goes to interest. What if we were to prepay $11.29?
Yeah.
What if we were to prepay $145.60? Knocks out a whole year.
Yeah.
All right. So then your next mortgage payment, if we made this mortgage payment in January, gave the bank an extra $145.60, our next mortgage payment would be here for February. Look at that. It is amazing. Control the principal payment, ladies and gentlemen, and you control the loan. Interest rate is a liar. So if I had a higher interest rate, I would want to know, how can I make that interest rate work for me? And this is what we do at the P.I.L.L method. So now you say, oh, I don't desire 19%, but if I had to get it, look what I could do with it. I'm just saying. What do you think about that?
Yeah. Interesting.
I want to hear from Laura, because Laura, I know you had a lot of questions, and I said you hear this the first time, and it takes a while to catch. So every time I listen to Don's videos, it has me thinking of different things differently, even from the little bit of money that he's showing us right now on just applying it to our clients' mortgage. In this scenario, with a little bit of money, you could wipe out a year worth of their payments for a very little amount. If you add up all the principal payments, I think that'll be an amazing gift, Mario, to knock out a year's worth of mortgage. Wouldn't that be a better gift, Mario?
Oh yeah.
If we just wiped out a year's worth of their mortgage, and it versus giving them a monetary gift. I don't know, you the broker. I'm like, can we knock out a year worth of mortgage for them? And this is scenario.
That's quite interesting. Yes, we can actually. As long as we're paying the principal and it's disclosed, yes, you can.
So Don, there's some things we talk about off the record that we do for our clients that nobody else can do, because we understand, and we're getting better understanding as your students of what we can do and how we can affect families, and put them in a better position, because we understand the finances better than I believe any other brokerages out there.
Any questions or comments, Ms. Laura?
Well, I'm just thinking about how we, even through our partnership with Around Town Properties, because of that, we have the ability to provide up to $7,500 in closing cost credits. So my brain's just spinning over here. Like, how could we use that to help people not necessarily lower their closing costs, but also, reduce the interest that they're paying over time. So,
oh my gosh, Miss Laura.
Don, I wish we could get all our clients excited like you just got.
Listen. Because I heard $7,500.
I know.
And I said, yeah. Here's what you could do for me. All right. If you could give me $7,500 for closing credits, that means that's $7,500 I don't have to pay.
All right. So let's do this. Let's do it in a scenario of a home right now that's average price, right? So
okay. Talk to me. Go on, Alex. You listen. I'm excited now.
Yeah, exactly. So let's get it so that people can understand, because some people can buy a $600,000 home. So let's bring it down to something that's a little more affordable. So right now, let's say a $315,000 home.
315.
No money down, right? So we'll
no money down. Okay, 315,000.
Right, Jerome? Right. That's a good price, right? To look at.
That's a good price.
All right, we'll do an interest rate. 7 is good with you, Lauren. We go 7.25.
That's good.
Okay. All right. So everybody's on the same page here. So let's go.
There we have it.
All right.
Okay.
So if we give somebody $7,500, how much would we knock out?
$7,500 on this? Look here.
So
2 years off the loan.
Yep.
And we're saving $47,261.86. I have to put it here instead of here.
Sure.
Because they do have to pay 1 month's worth of interest, which is $1,800.
Correct. So you're basically doing is you're paying for 2 years worth of interest, and they're saving nearly $48,000 in savings.
Lord have mercy.
Yep.
But I'm telling you, I'm trying to stay in my seat here and be professional.
That's a lot of money.
That's a ton of money.
Yeah.
So here's go ahead, Jerome, because I've got something I need to share.
This is type of stuff that when we come together and with Mario and Alex and Laura, we can show different illustrations, off the screen. That's why people need to do consultations with us, because we think out of the box every day, and we've been thinking out of the box for years. And in this case, this is the most value that I've seen anybody come up with. If we can implement this strategy and show people, and it covers a lot of different things in our box.
Wow.
This actually is better. If you think about it, guys, it's better than a traditional down payment assistance program where you might have to stay in the house for 10 years, or you might have to do 3 years. We still knocked out more interest than any of all those other programs, right? That's even giving somebody, say they got to wait 10 years and give them $30,000. That one illustration does that for a client, and they don't have mortgage insurance. And we showed a family how with an extra in this example that they could take an extra $300 a month and wipe out interest, in this case of $1,800 a month.
Wow.
One strategy.
Wow. Listen, folks, this is exciting to me. What else are you guys seeing as far as incentives out there, either from the lending side or the building side, that we can use in these scenarios? Somebody's online here on Clubhouse saying, I wish more people truly understood interest cost. And that's what we're talking about, folks. Interest cost versus interest rate. Interest rate is a liar. Interest cost is the truth. How much interest are we paying each month, and how much can we eliminate? The key to managing your debt is not how fast you can pay off the principal. It is how cheaply you can borrow the money. Oh my goodness. What if you can get this money at 75% off using AI to do all of your calculations? I'm just saying. That's what we do here at the P.I.L. Method. Our AI system does all of the math for you. I mean, because this is paying off a loan is very complicated, right? It's more to it than you might think, because for every dollar you apply, don't you want to save the most in interest you possibly can per dollar?
Mm-hmm.
You want to maximize each dollar. So by maximizing each dollar, you want to pay at a particular time, you want to pay the least amount of money that you have to prepay to maximize the amount of interest you can save per dollar. Putting too much on at the wrong time actually can hurt you in interest savings, because once you maximize something, you can't do more than the maximum. Maximize how much interest you can save per dollar. You can take the rest of that money and invest it in building generational wealth. So you can save interest over here. You can make compound interest over here if you knew how much to apply towards the mortgage and how much to put towards your investments. Oh my, now we're doing some fantastic work. I'm even more excited. What do y'all, come on, give me some scenarios to work here. What do you got for me today?
Alex, can you tell them what because you do a lot of listings, let's talk about closing costs and builders paying the closing costs. Who wants to tackle that? All the incentives the builders offering.
Yeah, so that's one thing that I was actually thinking about it when you were talking about what else the builder's doing. So one thing that happens a lot, Don, is, so let's say a builder has a home for, $330,000, but they're tacking in $15,000 on that house for prepaying interest rate so they can get a better rate. So technically the house is $315,000, but they'll add $15,000 to it to cover the lower rate, right? It's a rate buy down.
Okay, so, rate buy down.
So it's interesting to show people what that actually looks like payment wise, but also doing your scenario, how much money they're saving by going that route, or how much money they wouldn't be saving if they just did another way. So
let's take a look at that. So if we had 315,000, all right, and I can buy it down. Let's say I can buy it down to about.
315 will be at the 7%. 330 will be at like a 5% or something.
Okay, 330. Okay, and 330. So are we talking about a 5% rate or a 5.5%?
It depends. Like I actually just talked to somebody yesterday. They're already starting to go to 3.9s. So
you buy it down that far?
Yeah. Because the rate, like Laura was saying, you can already get it in the 5. So their builders are already buying it down quite a bit. So if you just do a 5 or 5.5, it's fine, just to get a scenario.
Well, let me show you what will happen if it's 5. Now, remember what I said before. Control the principal payment and you control the loan. Okay. All right. So we're going to calculate that. All right. Here's our payment is $1,771. What I ask my clients is, do you want a lower payment or do you need a lower payment? That's two very different questions.
Correct.
If they just want a lower payment, then I'll say, let's take a look at this. Can you afford the $2,095.70? That's principal and interest only here. Okay. As opposed to the $1,771 if we got the 5% rate. I need you to take a look at the 315, all right, at 7%. Take a look at this principal payment. It's $258.20. The next one is $259.71. When I lower the interest rate, look at the principal payment now. $396, $398. It takes more of my money to knock out 1 month when I lower the interest rate. By lowering the interest rate, ladies and gentlemen, everybody who's watching this prepay, by lowering the interest rate, I just made it harder to prepay.
Yeah, you did. And the other thing about it too is your balance is going to be higher. So when you have to leave, get out of the house,
yeah,
you're at $15,000. Regardless of what you've done, you paid $15,000 more for the house.
You know, I didn't realize that. I thought the builder was coming out of his pocket for that money. They're just adding it to the price of the house. Yes. Get out of here. I didn't know that.
Well, I mean, they're not advertising that way, right? But if you buy it cash, right?
I did not know that. Oh my goodness. Listen, folks, I'm saying, instead of doing that, there's a lot of things you could do with that money. If you want to buy it down, now let me show you something here. Let's take a look at 1 year. Okay, 1 year on this, $3,200 knocks off a year at 7%. It takes $4,800 to knock off a year at 5.5%. And the lower you go, the harder it is to save money and get out of this mortgage early. Our average client gets out of debt in about 7 years.
So, Alex, on a lot of the clients, they're also bringing
as well.
What's that, Laura?
Say that again?
I just want to throw another scenario for consideration into your calculations here.
Please, Laura.
Something, just for comparison, especially when you compare a traditional conventional mortgage with PMI, if the down payment is less than 20%, to our no PMI loan program. I feel like that the cost of PMI, the private mortgage insurance, should be factored into all of these things, because that's an additional savings, and that's also going to be part of a payment that, the payment's really not going to be $200 or however, whatever that last scenario showed the difference between that 15,000, because you would still have the cost of the PMI added to the mortgage payments.
Wow, Laura, am I here? Listen, tell me if I'm hearing you right, because from what you said earlier, if I have no down payment, if I have no PMI, then my interest rate might be slightly higher.
Correct. The rate is to be higher. There's always that trade-off, right?
Which would actually benefit me if I knew how to read that amortization schedule.
It would by a whole lot. You and I are on the same page, Don, because what happens is that extra $200 a month that you've been paying in mortgage insurance will go strictly to pay it down, right?
Oh my gosh. I get a higher interest rate. Listen, folks, I don't know where else you're going to go to have somebody get excited about getting a higher interest rate.
Right.
Okay. I get a higher interest rate. I get no PMI, and I don't have to put a down payment down. Lord have mercy. Help me today.
Don, what we didn't factor in the illustration that Alex is showing you.
Yes.
That you purchased a house for $330,000. That client still has to bring at 3.5%, $11,550. So we didn't factor that in either.
That's for an FHA, right?
For FHA mortgage. So let's say the builder bought an FHA loan down. I'm just saying that for illustration. If the client has to bring $11,000 to the table, we forget how much interest if they did zero down and they had 11,000, how much interest they would save by doing it the way that I believe that people should purchase is apply the money after you get the loan.
There it is.
See, now it's not just 11 because you still got her 7,500 on top of it, right? So that's what I'm saying. When you add it all up,
Alex, you better stop. I'm trying to stay in my seat.
Well, but I mean, that's why Jerome and I was talking about numbers. Like most people don't understand the actual numbers because if you do the zero down, you're saving 12,000. You can put that 12,000 later in the house plus the $7,500 that's just given out. So now you got quite a bit of money, right?
Based on a percentage of the loan amount. So I just want to clarify, it's not going to be 7,500.
Yeah, no, this is just for this scenario, right? That we're getting. So let's say it's 5. So you got 12 plus 5. That's $17,000 that you can put in the house later, right? Make your first payment, 17 grand in.
17 grand.
Yeah.
It looks more like this. Knock off over 3 years.
Yeah.
Lord have mercy. Save 52 grand in interest.
Mm-hmm. And
so
if you're at 312 and you're at 312 in loan balance or 313 in loan balance as opposed to, the 330, whatever.
Wow. I'm getting all excited about this thing right here. So now this is at the 315. So if we did, what did you say? 16,000, was it? What did you say? 17,000. Okay. Yeah. 17,000 at the higher interest rate does this.
Correct. You're not taking the price up and you're not taking the lower rate, but you're getting all the other advantage, no MI and the extra credit.
But look at the equity. Look at the equity that you get for the price. All right. So this equity, now we're disregarding right now what market conditions here, but just the paying down of the loan, 17,000 cost $100,000 in interest. Mm-hmm. I can get this $17,000 added to my principal, not for $100,000, ladies and gentlemen, but just for $1,837.50. Ouch.
And we're talking elementary right now.
Yes. This is not even
right now. This is not even the power moves that we talk about. Why would somebody put $200,000 on the house or $11,000 on the house? And could they find a way to get a better return on their money? And in this case, with $11,000, I challenge someone to say, if you had $11,000, could you make $600 somehow for the year to wipe out? In this scenario, almost $3,000, almost $4,000 of your interest on a mortgage.
My goodness.
But if you want to look at it from that's more advanced. What we're talking about is so elementary, how much money that Laura, Alex, and Mario could save a family and myself because we understand these strategies very well.
Well, I tell you what, with our P.I.L.L method AI system, we have a client that is making more money now than they used to. So when they're plugging everything in, they are able now to pay off the final $263,000 that they owe in just 3.5 years. And they're only going to pay $16,000 in interest. Wow. He was surprised to hear me say, you're paying off the house too fast and you're not paying enough interest. He says, what do you mean? I thought that was the idea. I said, tell our program that you're making $2,000 a month less. And the program recalculated. Now he's going to be out of debt in 6.5 years, not 3.5. He's going to pay $20,000 in interest instead of $16,000 in interest. He says, Don, why would I do that? I said, here's why.
Benefit. Yeah.
Yeah, there you go. Who said that?
Me, Alex. Yeah.
Alex, what do you hear? What are you seeing in this, Alex, already?
Well, I mean, you need some of that for write-offs and offset your income. So you're going to be paying more taxes. So now you're taking from one end but losing in the other. Okay.
So here's what I told him. I said, if you do that, let's just say you want to put the $2,000 back in for 3.5 years. That's 36 months plus 6 months. That's 42 months. Okay, 42 months at $2,000 a month. That's 84 grand you want to put into debt reduction just to say go from $20,000 in interest paid to $16,000 in interest paid, 84 grand to save $4,000. Is that how you want to spend your money?
No.
He said, well, no. You know what he did instead? He got a HELOC on the current house, put a down payment on a much larger house, put a renter in his old house, and now he's going to pay off both houses in 10 years.
There you go.
Mm-hmm. So there is a point at which more is too much. You need to find out when it doesn't make sense to prepay anymore and take that extra money and use it to build wealth, ladies and gentlemen. Don't just throw all your money at the debt and think that that's going to be an ever increasing benefit. No, it is a decreasing benefit. As you pay more, you save less. Find out when it's going to be the best time to save and the best time to earn compound interest. You can do both at the same time. You don't have to choose either or. What do you think, ladies and gentlemen?
That's pretty good. That makes sense.
Oh my goodness. I just get so excited. What else can we talk about?
Well, Don, the first thing is I know a lot of people are going to be watching.
Yes.
We're going to put it on our platforms.
Mm-hmm.
One of the things, like I was telling Laura yesterday, I said, when my wife told me to start listening to your videos again, it probably took me about 4 hours worth of into videos of 6 hours to really grasp. And today it actually something that stood out to me, what you put on the screen, because I'm a student of this.
Yes.
And one of the things that helped me was your book, where I was able to read the book that you have and look at the amortization table, understand it, look at different strategies to apply. But it gave me a great understanding, even though I was in the business a long period of time.
Mm-hmm.
I was able to talk to people and our clients in a different way so they get understanding to cut down their fears. Like one of the things started at the end of the show. So people, in my opinion, need to go and listen to this video over and over again. They want more information to get your book so they can get an understanding how to pay less in interest, and then not let anybody just try to sell them on anything because they have an understanding for themselves how to pay less interest by borrowing money.
I think it's important that people know how to get a hold of all of you. Okay. Mm-hmm. So if you want to put your information in the private chat, we can put it up there, or you can just tell people what is the best way to get a hold of you guys.
Mario, what's the best way to get in touch with you?
Well, I'm actually putting it in the chat. Usually my phone number. I work 7 days a week, and I am available to help. 7 days a week. This is our full-time jobs. Everybody here is, in our office, are full-time licensed realtors, licensed broker, and we work the 7 days. We work when you're off. We're there to help you.
Wow. Okay. So are you putting that in the regular chat or the private chat?
Private chat.
Okay. All right. I'm looking for it.
Yeah, put it on there too. Big.
Should we put it on the comments?
You can put it in the comments as well.
Okay.
All right. People need to know how to get a hold of you all. This is important. Okay. And so Jerome, I'm going to ask you, let's see here. Let me go to the private, and I've got, let me see, Jerome, I got your information here. Zero Down House is a website. We're going to add that Okay, we're going to copy that. We're going to add it.
Laura,
And
did you put the chat?
is there a phone number? Okay, Jerome, you got a phone number here. All right, I'm going to put this phone number in here as well, so they can call one phone number and get a hold of all of you guys. Okay, so let's copy this and put that phone number in. And for everybody that's on Clubhouse, I'll do this as well. So everybody on Clubhouse, you need to be watching this on YouTube. And Nikki wants to know, does this work with credit cards too? You better believe it does, Nikki. And so here's Jerome's number. Get a hold of him, and you can get a hold, and he'll help you to get a hold of. Let me take this off the screen. Get a hold of Laura, Alex, and Mario. And listen, folks, you guys have been a wonder. You have been fantastic today. Is there any other scenario that we can do to kind of finish things up here today? Because I know you guys are busy.
Yeah, there's one more real quick. So we talk about this one quite a bit. It's like, and I mentioned it earlier about the timeline of people live in houses, right?
Right.
So if you put down your 3.5% on the house, and let's just for the sake of numbers, let's just say it's 15,000, right?
Yep.
And you live in the house for 5 years. And by that difference of the $15,000 down or the zero down, how much time it would take you to actually pay that $15,000 into the house? So, for example, let's say that the house is, we'll do the same scenario, 315.
Okay, that's what I have here, 315.
Yep, so you're 315, right? So if you
Right.
do a zero down program, and I'm talking about now is your down payment on the house would be at 3.5, right, Jerome? So let's see, 315, real quick here.
Okay.
So 3.5 will be about $11,000, right?
Okay, right.
So if your payment, if you pay that down on your principal interest, since it's an FHA loan, you only get about 7,000 of that to lower it. So your payment would be based off about, let's say 305.
305. We're going to
Yep.
change that to 305.
Right? Okay. So you're going to need to probably copy another screen there. So let's say
got
305, right?
Got it.
All right. So, okay. So the payment on that will be 229.17, right? So do
Yep.
another one at the 315.
And here it is. It's on the
You already have it.
315. Got it. Okay.
All right, so our payment on that one is 295, right? So
Yep, 2,095.
minus, what was the other one?
2095 versus 2029.
2029. So you got $66 a month, right?
Yep.
So if you got your $11,000 that you put down, how long would it take you for you to pay that 66 per month?
Ah.
Right?
All right.
Divided by 11,000.
66 divided by 11,000.
It'll be 11,000.
You mean 11,000 divided by 66?
Yeah. So it'll be 166 months.
Woo!
Divided by 12. So it's 13.8 years. That's how long it'll take you to actually pay to basically make up that difference.
Right.
If you did what you're saying, instead of me saving that $66,
yep,
by putting the down payment, I could put that money into the principal
prepayment,
and it would knock down a whole lot more, and it would make a much bigger of an impact than trying to come up with that 3.5%. But when we try to break that down to people, a lot of people just don't understand, they don't grasp. So having this
showing
them the
numbers, them the numbers. Now, this is what I use to help show the numbers. This guy that put this amortization schedule together, his name is Brett Whistle, BRET WHISSEL, BrettWhistle.net. I use it because he has an amortization schedule that shows cumulative interest and cumulative principal. And once people see the numbers, it becomes a lot clearer. Okay.
Right.
All right. And so with that being said, before we get out of here, here is an example of our program. Our program looks like this. This is what runs everything. We put all of your accounts in. Okay. All the mortgages, everything that you have here. Okay. We put all of your, wait a second here. We put all that in, and then we could do different scenarios. So if I want to do reset this account and do this, let us do this one. Okay, that scenario. And what we're looking at here is on the accounts, I've got a car loan, $4,800. I've got a Discover, $8,000. Student loan, $30,000. Truck loan, $15,000. Motorcycle, $6,000. And a $305,000 mortgage. And this is old interest rate, 3.25%. Okay. So that's a total of $368,000. All right. We already know before we even get started that this family is going to save about $142,000 in interest. And because of that, be able to pay off everything in 4.2 years. And this is the budget they're working with. Rebecca makes $1,750 biweekly. John makes $2,100 biweekly. Their monthly income averages $8,341.67 over here. Monthly expenses $7,005. This is the average. So their average discretionary is $1,335.71. And this is what I was talking about before. The program tells you how much to put in savings, the money you don't need for anything else. Here's another one. The program tells you what to put in savings as you're paying your bills. The program tells you what to put in savings as you're paying your bills, and then tells you when to prepay, like the credit card, when to prepay the mortgage. So you're saving up money you're not spending anywhere else. We're tracking all of this for you in this program. So if you want to know the month, day, and year you could be debt free, go to ceodon.com. I'm going to put a banner that runs across the screen. ceodon.com, ceodon.com. And when you have that, understand that, go to where it says get a savings and earnings report. You can know the month, day, and year you could be debt free. And this is a free report. So go to ceodon.com and request a savings and earnings report, and you'll know the month, day, and year you can be debt free. Listen, I want to get final thoughts from everybody. And ladies are always first.
Well, I'm excited. I'm great.
You're breaking up, Laura.
I'm sorry. Hear me okay?
Okay, so maybe we can come back to you. All right, Alex, why don't you go while see if we can get a better signal on Laura.
Sure. So, we live in Houston. And when I say we live in Houston, we live Houston. We go to sporting events. We go to art museums. We bring people over to visit the city. We spend our money here. We help people here. We've helped over 3,500 families over the years doing what we do. And the cool thing about it is we would love to help people buy not just their first home, but build something to help their family in the long run. So the asset that you mentioned as far as buying something and turn into investments, we've done that with a lot of our clients. And it's something I always try to explain. I always tell them about making extra payment to knock their interest down. So we try to get all these things and be an asset to people. So when they have questions in regards to real estate, they come back to us. But the hardest thing is to get in front of the people and get them to understand that, we understand money. It's like Jerome said earlier, it's not just the buying a house, selling a house. It's more of understanding the money. Sometimes things make sense, sometimes they don't. So by sitting and analyzing it and breaking things down, as opposed to just let's go buy a 3-bedroom, 2 baths, we can make a bigger impact on somebody's life. And really 10 years, 5 years from now, they'll look back and they said, okay, they really did help me, not just put a house together. So that's what we try to do. So.
All right, Alex. Thank you. Laura, let's try you again. Okay, you're mute. Yeah, we were hearing you great before, but you're cutting out for some reason.
Hi. I just wanted to say that I and
Laura, you're breaking up again. Try speaking just a little bit louder. Maybe we can overcome.
Can you hear me better now?
Yes.
Okay. I was just saying that I've learned so much today, and I appreciate the time that you've put into this. And I look forward to sharing this and what I've learned with my clients, my friends, and like Alex said, this is a wonderful place to live, and if we can save money to enjoy the things that the Houston, South Texas area has to offer, that's what life's all about.
All right, Laura, listen, that ceodon.com, that is my digital business card. Please put that on your phone and click so that you can stay in touch with me. I want to talk to each and every one of you guys offline. So contact me at any time. Thank you very much, Laura. Thank you, Alex. What about you, Mario?
Well, thank you, Don. Did learn some stuff today. I really appreciate it. Didn't know about the P.I.L.L method. Now I'm going to start following it and actually helping my clients. Houston is a great market. I will tell you that this is the best time to buy as interest rates are higher and everybody's sitting on the fence. I will tell you, you might pay a little bit more in interest rate right now, but with the P.I.L.L method, you won't end up really paying it. If you turn around and buy your house now, you'll save more money than down the road. Because I saw this in 22 when the housing market went crazy. That house that used to be $180,000 is now $280,000, and people are paying $100,000 more for that house. What's going to happen with next year's? And I am talking to small independent builders, and I talk to everybody, and their investors are now dumping hundreds of thousands of dollars trying to build new construction right now. Got one small builder, they build about 20 homes a year. They're ramping up for next year to build about 50. So people are dumping money into the real estate market because they know a switch is going to happen next year, and everybody's going to be hitting the wall. And it's best time to buy now and do the P.I.L.L method and save more interest rate than pay more money for the house, and then you're back at square one.
Wow. Okay. So, Jerome, final words from you, sir.
Well, I'm a big fan on this strategy we've been using for years, and what I'm excited about for our team is that we literally we put people on plans, but with the P.I.L.L method, Don, we could literally show them how to buy a house. We could show them how they could pay that house off in a shorter period of time and pay all of their debt off by using this process. And our team will talk about how we can utilize the program and get that free report while they're purchasing the home, so they can see what the end results are going to look at. One of the clients you did help was Dee Monet, and
yes,
she started with a plan with us in Houston. We helped her purchase a house in Florida, but she's gonna, I can't remember. She's going to be out of debt, I think, in less than 6 years, I believe, Don.
Yep.
But she has no other debt. She knew it. We had her enter into the program. When she finished the house, she moved. Total cost out of pocket in her new home was probably under $1,500. But the powerful thing is that we put her in touch with the P.I.L.L method, and she's going to be total out of debt in less than 6 years with her house, and then she's going to move on and purchase another house.
Wow!
So I'm so excited that we were able to put her on a plan like other families. And there's some other clients that enter into this program, but they know that with confidence they're going to be out of debt and they're going to pay less interest. Thank you so much, Don.
I'm excited about this whole thing. So folks, I appreciate you being here today. So what we're going to be talking about is using all these strategies. There's incentives out there. There are different ways of looking at this, but here's what we don't know. Why is the lending situation the way it is now? All right. The self-amortizing loan has been around since 1936, and it came into being as a result of the Great Depression. All right, and the banks, the government bought up all of these foreclosed mortgages and reissued them as 20-year amortized loans, and then they took the loans and then sold them to investors. And that practice still happens today. Most of our mortgages are sold on the secondary market. So this is why the majority of us are not taught the benefit of prepayment and how much interest it can actually save. And most people don't know this. And this is why it is hard for them to wrap their minds around it. Because if most people knew that $1 could save you $7 in interest that the investor would not get, would these loans be as attractive to investors if everybody knew the benefits of prepayment? So listen, folks, stick with your people, make sure they get this information, help them to borrow money more cheaply. So remember this, you can't optimize what you can't measure. We provide you a way to measure your outcomes so that you can save the most money that you possibly can mathematically in interest, and take those interest savings and invest it in your families, in your business, and stop giving it to the banks unnecessarily. So enter into that business contract. I love borrowing money, but you know what I love even more? Borrowing it at a 75% discount. What about you? Thank you, everybody. And I hope to be able to see you again soon. Please give me a call. You got my information. Let's talk offline. All right.
Thanks, Don.
Thank you, Don.
Thank you.
Thank you, everybody. And we will. I forgot to put my phone is ringing already. I gotta go. Thank you, everybody. We'll see you next time.
Bye-bye.
Bye-bye. All right, folks, we're getting out of here. So let's go ahead and say goodbye to all of you. I hope you enjoyed this show. We'll be back next week to do it all over again, to give you more information about how you can save more money. All right. We'll talk to you soon. All right. Have a great rest of your day and a wonderful week to come. All right. Talk to you soon.